All right, another day, another post. Don't get used to this, but I said I was going to update after yesterday on what happens, and so I am doing that. So, wanted to keep my word. And welcome back. If you don't know who I am, Ben Collins, Chief Investment Officer, founder of Options Autopilot. I'm a CFA charter holder and just an options enthusiast, although the past few days have been difficult to be an enthusiast here with options. But wanted to go over the portfolio, kind of show what I'm seeing, and talk about what I did today and what my plan is moving forward and what I kind of started doing today and what I'll do depending on what happens. So if you recall from last video, or if you didn't watch it, you can go back and watch what was going on. The futures were obviously down pretty big in the aftermarket, or I guess the pre-market, Sunday night and then into Monday morning. Obviously not feeling too great. You saw where I was at on a P&L basis from, how much I was losing at that point. I think I was down like $13,000 was what it was showing. So obviously a little bit lucky today. And I did take the opportunity to kind of reset, reduce risk, and then just kind of step back a little bit. But I did also put something else on. So I just wanted to look at what we actually did here today. Basically, if anyone was paying attention, we were basically dropping, and we were around the point down like 4% or whatever we were kind of pre-market. We ended up kind of opening and falling and getting to that point. And then, something came out, some headline came out that supposedly, out of the White House, they're potentially going to pause tariffs for 90 days. And the market rebounded very fast. Up until that point, I hadn't done anything. I don't recall exactly what time it came out, but it was kind of sitting around where I was originally. So I was like, well, I'm not going to do anything yet. Let's see, what happens. You don't want to usually trade within the first half an hour. So I was just kind of letting things settle out to see what happened. And that came out. And as it was coming out, I was like, well, okay, this is very positive, and this is kind of what I was hoping or thought would happen on Friday, which is why I was leaving things on, but that ended up being stupid. I should have just left the automation running and gotten stopped out, and I wouldn't have had to stress about it. But anyways, the market just was ripping higher, and so I basically took the opportunity to actually right before that, I had rolled my 111 on ES. So this is the roll right here, and I always had to do it for a debit, but I just wanted to kind of reduce margin requirement, and also just give myself a little more room for it to work out, because ultimately it could still end up as a decent credit from that standpoint. So this is that trade. I was trying to do the same thing on my MES, but it wasn't allowing me to roll for some reason. I just roll the strike. So I basically just closed that down as the market was rallying then. So, okay, so I guess we can see that when this happened. So I did this right beforehand, and then the market started to rally, and I basically took the opportunity to close this down, again, giving myself some more equity, and obviously reducing if it happened to roll back over. Because when they were talking on CNBC about the reports out of the White House, I was like, if for some reason it comes out that it's not confirmed as an actual, White House statement, then this whole thing could roll over. Obviously, I didn't know that or didn't necessarily expect it, but I just figured I should take the opportunity as it was being given to me to kind of cut down risk. So I'm glad that I did that. Also on SOFI, I basically closed down the short puts that I had. I think that ended up being like a pretty decent idea. And then I did put on later, I just enabled the automation again for a 112, and I basically just did 2 contracts and actually shorter term days to expiration just because volatility is higher. This was something that we're just working out with the automation in terms of the gold. So I don't actually have a gold put spread or put credit spread on at the moment. I have it set to run tomorrow. So that is just not related today. This is what I currently have open. I'm still just long the calls. I think when I took off the SOFI puts, it was closer to $10. At a certain point, it had rallied to like 10-20. And I think it was actually up before they even made that announcement, or at least flat. So that's positive for SOFI. Obviously, it's fallen a lot, but Intel, same kind of okay, whatever kind of scenario. Just holding the call still. I'm tempted to add, but I am not going to add at this point because that kind of breaks my rule of only adding when I'm actually positive on long positions there. So basically have the MES on, and then have the ES if my computer will work correctly. There we go. So I rolled this down. So I've now rolled it twice. I basically rolled it from 4,800 to 4,600. Then this morning I basically did 4,600 to 4,400. So just giving myself more room. Moving forward, maybe the rest of the week, if for some reason we end up being up, I might end up closing down ES. So my plan is now, because VIX is so high, I do think it's a good opportunity, but you just have to be cautious in terms of selling vol, because it can. Look at how much it opened up and then it kind of collapsed down, right? So imagine if you could just have been out of the market and then selling right here at the open. That would be pretty amazing, but you just don't know. Obviously, volatility is mean reverting. It will mean revert eventually, but that doesn't mean that the market doesn't continue going down or is technically going up. But it should mean that if you're short Vega in general and long Theta, you should be helped by that movement, but it doesn't mean that you won't have any losses. So got to manage risk. So my plan is, and I think I've talked about this before in terms of adding a VIX kind of filter for Options Autopilot. Still working on that, but I kind of want to do it myself manually to sort of test it out, prove it out. And my plan is I enabled an MES 111 to run every day of the week. So I'm basically trying to dollar cost average while volatility is high and the implied volatility is high. Let's pull up MES. Come on. Guess my computer is struggling from all the volatility. Or maybe I guess it's just Tasty Trade is struggling. Or I'm just struggling to notice where my trade is. So 72 days expiration. I basically did one that's 73. So the system will look at 73 or greater. So should be that tomorrow it'll open up a 74. And then subsequently, as it kind of declines more, it'll end up going to 84. So that's kind of my strategy, because I want to be able to put on more in smaller size and basically kind of it's like I'm dollar cost averaging every day into volatility basically, until it kind of drops to a certain level, or I set a max kind of number of positions. What I'm thinking through right now, I'm probably going to change. Like I said, if we end up being up, I'm probably going to pull the ES off, just in terms of having that larger exposure. Not that it's huge, but just for this account in general. And then I'll probably add some capital, and maybe I'll go back to doing ES, but and doing more of them just because it is a good opportunity. But if I take this off, I'll probably reduce this down to just one contract and do it daily. So either way, I'll probably reduce this just because I don't want to be a hero. And of course, when I do that, I'm sure the market will just rip and it would have been better to do size. But you just living to trade another day is the key. And ultimately, I kind of feel like this is a little bit of a relief. We might get a little bit of a fall through relief rally, and if that happens, then I'll probably take a little more risk off, and then just do it over a longer period of time, because I don't think we're out of the woods on any of this stuff. It's hard to obviously forecast any of these things, right? But that's just the nature of what seemingly they're trying to do, and obviously they probably can't say what they're trying to do fully from the White House. Otherwise, they would kind of show their hand, so to speak, and wouldn't be able to actually negotiate things. They probably can't say, and really can't actually change what they're trying to do if they want to accomplish it somewhat. So McClellan Oscillator, you can see, is pretty oversold here. We did get a little bit of buy-in in some of the tech names, so some of the forward PEs look cheaper than historical. Obviously, that can happen because earnings expectations haven't actually come down yet, and then they might, so they might not look as cheap in the future. But in general, that bodes well for people maybe finding some value in the market, in certain areas of the market. And given that the Mag 7 is still a large weighting in the market, if those PE ratios are getting attractive, then that could lend some kind of support to the market. Again, you never know. Some interesting stuff. Obviously, we saw interest rates going up today, which is, I guess, maybe understandable. Depends on how you view it. Some people might claim that China is, selling treasuries. I think that there could be a potential that people are selling their bonds and buying equities, which is also playing into it. I don't know if that's the case either, but we can kind of see this move down pretty severe. So kind of reverse this entire move up almost. It's kind of in this range of the uptrend, but I'd still say be cautious. You don't necessarily know what's going to happen here. But I do have my automation set to run 111 on the 30-year bond. So I do feel like it's a decent spot. And I had talked about how I unfortunately had missed out on benefiting while the crash was happening from putting on a 111. So I guess this gives me a chance to kind of reload there. Same thing with crude oil. Again, I'm trying to stay diversified. I don't want to go too crazy. Obviously, we saw this massive move down and a little bit of stabilization here. I don't know if it's done going down, if we truly are trying to create a recession in general to try and get rates lower, then demand really could fall. But in general, I think there's got to be a steady state amount of demand, right? If someone knows in the comments, feel free to post it. But that is kind of my thesis. I do think it's, again, this is one of the benefits, hopefully, of doing this. Like, it's kind of de-risked itself a lot from the move. Obviously, we're down year to date on crude oil, but if we even get a few wins, we'll be right back to break even, and we've got quite a bit left in the rest of the year. So we can see, I guess it's an update. So ultimately, year to date gain is now minus 69.47. Obviously, still not great. With fees, even worse, minus 77.37. Is that 37? Yeah. Your eyesight goes when you get older, but way better than it was. And like I pointed out before, and I think I even added up today, I think 4,000 of this loss is actually from manual trades, so it's not automation. I'll show you autopilot, but right now some of these I haven't imported some of these because I had to modify them outside of the system, so I need to import them to have the P&L be accurate. So I don't want to show an inaccurate P&L. This is obviously right at my brokerage account, so this is what it is. So in terms of crude oil, we can see we had these wins, a little break even, then a big loss. We should be able to make up for that over the rest of the year and hopefully make money. Same thing in terms of ES. We basically had some pretty good wins, then a big loss. Okay, that's interesting. Oh, okay, got it. So this is factoring in, I guess, both the realized and unrealized, because that looked weird to me. But still manageable, I guess, from that standpoint. It almost seems not accurate, but I guess it is. That's not terrible. That's survivable. MES obviously is a bigger one, but like I said, you know, I got rid of XRP to kind of free that up. I'm sure that'll probably rally back. I'd rather probably earn a return through the futures and the options, given how high volatility is at this point. So that's kind of my strategy of why I did that. Same thing with the short puts. You can see how much of a loss we've got so far on SOFI. Obviously I was expressing a long direction, but at a certain point, it's like the margin that it's holding is now, it's like a fixed amount of return I can get from the short puts, unless I wanted to get truly assigned, but those weren't going to get assigned for a year because they're a year-long option. And I was just kind of expressing along. So I basically decided to free up that capital because I can use that. I think it was like around $2,500 or whatever. I could use that on some MES and likely earn that back a lot easier than just having it go in my favor. And like I said, I left on the calls. That's why I was debating buying some more calls, just like my delta was higher when I had the short puts, of course, along with the calls. But figured I would kind of reduce my overall like directional long exposure if the trend is still downward longer term. So I think Bitcoin is, I haven't even really looked at Bitcoin recently. I'm assuming it probably stabilized and was okay by the end of the day, but let's check it out. Because we're kind of just going back to the plan of, oops, apparently I typed in incorrectly. So yeah, kind of, it fell, but kind of stabilized. So again, we're getting kind of closer to we're getting close to those levels I was kind of talking about that I would come in and touch, and hopefully would be support now. So again, a decent place to be doing the put credit spreads. That's set to go on again tomorrow. And so I feel decent about getting those reallocated and getting a little more diversification here. And like I said, the name of the game is going to be dollar cost averaging my volatility through options positions and the 111s on ES at least. So if we take a peek again, and some people were talking about this, I would say, like I was saying, it felt a little bit like March 2009, but it wasn't super, super crazy. It is very high, but it's possible we could continue to have some higher volatility and it kind of like slowly trends down. The way that the market seems to move these days in terms of it quickly moving up, it seems to quickly collapse as well. And I'm going to guess because a lot of people are trading volatility, but if we kind of look at different time frames, obviously 2020, we got even higher. So it's always possible we can go higher. I don't know what else is going to surprise the market at this point. Who knows? Maybe, unfortunately, we start a war or someone attacks us. That would be bad in general. But if we're kind of looking at these spikes, sure, there could be more volatility and more to go. But I do think a lot of like the quick move is probably over with. If we still continue to trend down slower, obviously we know that the one-on-ones can still perform. It's just that we unfortunately haven't been in the environment, which is why it's annoying. It's like we kind of were in the environment. Some people were finishing the bear trap, and then some of them that were about to then ended up, we had this huge massive drop. And so it's like everything that could have been good actually ends up being bad, which gets very frustrating in general. But this is obviously a pretty good opportunity to be selling vol, but you still got to be risk managed and actually risk managed, trading small and then trading across multiple different asset classes. So it's just kind of back to the normal. Obviously it's annoying to be down, especially when we're up, but I feel this is a lot more I guess recapturable, if that's a word, than it felt obviously even this morning or last night. Um, and definitely, I mean, the automation only being down like 15%, not that that's great, but given how severe the move has been, I think that is, well, and I guess if I back out my own stupidity, it's even actually better. But that's including me, removing my stops basically, and that was my own fault. So it would be down even less if I had left those on. But not to just point that out because we have options autopilot. It's just the fact of the matter, and it's semi just proving the point that I should just not meddle with it. But I think to be good with just like letting it go at this point, given the elevated volatility and the potential for more drawdown. I'm not necessarily saying it would happen, but I do think there's probably no end in sight with the whole tariff discussions and the back and forth. And you just never know what Trump's going to say. But if they're trying to get rates down for refining the debt of the U.S., then that could be, a very tough battle, and they might not even get that. So we'll see. I mean, obviously, we can see that futures are up in the after hours. Who knows if that'll stay? We'll see what happens tomorrow, but that's kind of my game plan. If we get a decent rally, I might lighten up, pull ES off, and then just let MES run. Even though I dislike the illiquidity of it, the fact that we can have a lot more positions on and leg in more over time is beneficial. So that's kind of my game plan there. And we'll be adding in the other asset classes back in. So I wanted to, some people were talking about how credit spreads haven't widened. If my computer will respond here. Just did spread. I wanted to look at the high yield options adjusted spread here and see how high it's gotten. Okay, so I don't know what people are talking about, that it's not that crazy. I mean, I guess it's definitely not as high as COVID. That is very true. We're very far away from that, but you can definitely see that it's starting to peak up and breaking this downtrend. So I don't know if we'll get to the spreads of COVID. It depends on what the actual issue is. And I'd have to look. Yeah, it doesn't look like I can go back farther. What if we do max? Because that could be helpful to, okay, here we go. Yeah, I mean, I guess they did really spike up. I would say the financial crisis was a different time frame and a different issue, right? I guess, this one at the time, which was even farther back in the 2000, the dot-com crash, spreads only widened out to 10%. So we definitely do have some distance to go. I would say if you were looking for an average and it did get to almost COVID levels, not to say it couldn't get higher, that would maybe be signaling an issue, or actually would probably be lining up with a recession. You can see obviously this didn't really coincide until later, like kind of far in. Same thing here. So maybe we start out here and then it does a kind of spike towards the end, because we technically bottomed. Yeah, we bottomed March 9th, 2009. And I remember that because I was blogging at the time and I made a post, I think on the March 8th about it. And so you can basically see it's close to the peak around the bottom of the market. Doesn't always have to be that way, but I was just curious. People were saying we're not even close. We're technically not really that close, but it's at least increasing for sure in terms of high yield spreads. So if these blow out, for one, could be an opportunity to add to high yield, but in general, we are still close to the bottom end of the range. I didn't end up rotating my 401k just because we kind of finished more flat. Like if we would have finished 4% down, I would have for sure rotated it. And I'll definitely be rotating it more if we get more sell off. But so far, today wasn't the time in my opinion. So I want to bring this up as another thing, and this happened from the 0809 scenario. I had someone point this out, and I was like, oh, that's interesting. I should remember that for the future. So I always kind of keep an eye on this. And what it is this is a weekly chart. And so it was an interesting example of the 20-week and 40-week moving average, and how it can signal trends, basically. So it's not perfect, of course, but it can definitely give you maybe a decent idea of trend, and there's not a ton of false positives from it. I didn't actually count out how many times it got whipsawed or false positives, but you can put it in there yourself and see how often it actually kind of would work, maybe as a slower moving signal, and at least helpful maybe as either a filter or just another way to get an idea on maybe what the market's doing. That's what's so interesting about this time, where even COVID time frame happened over multiple weeks, right? Versus this move happened over, well, I wouldn't even say that's multiple weeks, but I guess it went into a couple weeks technically, but over one actual week it was massively down. So if we look at this, it still hasn't crossed over, which would be definitely bearish. I think we kind of already know if it stays under here, it's ultimately going to, because the moving average is going to end up crossing below here. And depending on how you want to do that or deal with that information, you can. But I'm just kind of keeping an eye on that. I haven't decided how I would potentially want to use that information this time around, because I'm not going to probably be all out buying like put protection and stuff like that. And we can even see I drew this previously, that we kind of came in, hit this diagonal kind of trend line. Again, the market doesn't have to pay attention to any of those things, but if it kind of coincides at two different points, if you're a technical person, what I do still need to do is overlay this with some fundamental earnings per share kind of projections, and that could maybe give us even more of an idea of where there could be value that either institutions are finding. I drew this kind of longer term diagonal trend line if we go out even farther. And I think Jeffrey Gundlach came out and said he's targeting 4,500 or whatever on the S&P. Things kind of overshoot to the downside, just like they can overshoot the upside. But my thought is, this market started to kind of go, not parabolic, but if we're thinking that it was going to come back towards the trend line and this keeps going over time, you could definitely see it closer to the 4,000 mark, or maybe a little bit less. That's where I think that, if you go back to Tasty, I tried to kind of keep some of these things in mind. So like this 111, I did widen out the put spread portion, and then this this naked put is all the way down at 39.50. Again, we've seen how quickly the market can get to places we don't think it's going to go, so I'm still keeping that in mind for sure. But the more that it falls, the more that we're kind of, like I've shown before, the more we're like selling under the market, and those things just, unless we continue to do this entire time, which anything's possible, but it seems unlikely, then it seems likely that we hopefully at least kind of go sideways for a while, get a little bit of relief, and that gives us the ability to do 111s, like even if the market kind of keeps falling, gets to 4,500, kind of pauses, like we'll be doing 111s, and probably our naked puts are all the way down at this level, right? So hopefully that kind of illustrates the point of why it should work long term, but you just have to manage these moves. Again, this is historic. I don't know how much I can re-emphasize that, is that these moves in multiple asset classes has been just massive. And I think it's obviously a lot of algorithmic trading, automation, and then just a lot more people. I shouldn't say a lot more people involved, but it's just more how easily you can hit a button and either rebalance or reallocate, and it just can build on itself in terms of to the downside and the upside, as we saw today, in terms of people starting to buy the dip when that headline came out. I'm sure that's a lot of sentiment based, hedge funds or headline watching hedge funds that are quantitative is kind of doing a lot of that stuff. But we just got to kind of stick to the plan, and I'm confident if we keep the risk managed that we can definitely be up for the year and stick with these strategies. I've had some people say they're cautious to put the strategies on, or I guess keep them on, and I totally get that. I think people should do whatever they're comfortable with. I do think that these are such high levels, like this would be the time to be doing it. I think your probability of success is skewed much higher, even though there could be more volatility in the actual market itself. We do know it will have to mean revert at some point over time, and it could stay elevated for a while. I just saw Meet Kevin was doing a video, and he doesn't necessarily know options, but he does decent analysis on the market, and I think he has a background in economics, which lends to some of his insights, which is kind of interesting. But he had some good charts on VIX and how they've functioned in other times in terms of the bottom, and how it basically doesn't necessarily, it can be elevated for a while and then spike up. So you just got to be aware that can be the scenario. So it can be elevated and then it can stay elevated, right? I mean, if we look at this is even higher than average, this yellow, and you can see at times how much it's above average and then how long it's below average. So you just gotta be consistent and just manage your risk. But that's why this should technically help over time to be short volatility. Obviously we can see our Vega exposure, so it can hurt both ways. If it spikes again, we'll go down, but we have less exposure than we did, right? I think when I was filming the other day, I think it was like an 800, minus 800, which is way too high. Obviously very helpful if the market was going to drop, and it increases as the VIX is going up, right? So the fact that it's lower now is obviously going to mean I don't get as much benefit if the market does rally and volatility comes off. But I'd rather just kind of cut exposure and then reallocate a bit slower over time, because we have the benefit of another 9 months basically of trading for this year. And so you got to stay in the game, stay small, and then incrementally do it over time. And I'll really be curious, because maybe that ends up being the default, like regardless, and we're just doing daily 1-on-1s. I've heard of people doing daily put spreads, or maybe it was even daily naked puts. And I don't know how they've managed that, because I thought they were saying they do them daily and it was 90 days out, but I don't think you can do a daily 90 days out. Maybe on SPX, but I'm not totally certain. But I'm going to look at MES and see where it starts. Yeah, I mean, ultimately, you'd probably have to choose different asset class. Apparently I can't type today. Yeah, interesting. So you can't, I mean, on SPX you can almost do daily. Yeah, I guess almost daily, 45 days out. Or you can do a SPY, because that could help you set a kind of frequency as well. Yeah, it looks pretty similar, not quite as much, but yeah. So you could be doing this a lot more frequently with certain instruments. Like I said, I'm gonna stick with MES and do what I can do here. and maybe at a certain point I'll get to doing it within 30 days, but I don't think that I really want to do that at this point. But I'll definitely be putting it on at a higher frequency while the vol is elevated. So that's my plan. A little bit of a relief today so far. We'll see what happens. You can see IV ranks at 102. I think it was at like 120 or something like that prior to the close, or just prior to during the market day. It was higher. So I'll be curious to see what happens here. Let's see where it's kind of been at. So I don't know. We'll see if this holds in here. Like I said, my plan will just be probably selling the rip a little bit and kind of just reallocating, letting the other stuff come on tomorrow so it's a little more diversified, and hopefully we get the benefit of the diversification again now that the massive moves have kind of happened and kind of sidestepped the gold one and kind of sidestepped the bond one. So hopefully that's to our benefit, even though it didn't necessarily benefit us on the upside for the bonds. But yeah, that's just a plan. I'll probably look at the cross asset correlation in another video and update a little bit later this week, depending on how crazy things are. Maybe I'll update again tomorrow if I have time, but we will see. If you appreciate this, like and subscribe. I'll just keep posting this and showing the results, showing the transparency, because I think it's good for people to learn and see real time. Because again, I don't see Tom King posting. He says he takes some losses, but that it's fine. And I do think he puts out good information, so I'm not trying to dog him, but he kind of stopped sharing his info. Maybe he does in his own members group, but he's not really sharing it that I've seen on YouTube anymore. So I thought that was kind of interesting. And I think that that's probably the most helpful for people, right? To see what really happens and when people take losses. So hope everyone's doing well, and just keep risk managed and diversified and live to trade another day. And definitely, yeah, just keep things rolling. Talk later.